Good morning, everybody, and welcome to this latest Harts webinar. And this one is going to be on My Mate Down the Pub Told Me About This and Other Myths. So all sorts of stuff we're going to be covering this morning. Hopefully you'll get something out of it. And if not, please know that this webinar is being recorded and will appear on our YouTube channel later on today. If you don't have details of our YouTube channel, just go to YouTube, search for Harts Limited, and you'll be able to catch up there and pick up any other details of any other webinars that we've had previously. As always, we tend to start with our usual disclaimer. I assume you can all see our screen there, which is the following presentation is produced for general guidance only, and professional advice should always be sought before any transaction is undertaken. Individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of their affiliates for any action taken or any decision made to refrain from action by attendees of this presentation. Okay, that's the formal bit out of the way. Other Harts online resources, please follow us on LinkedIn. Go to Harts Limited, follow us there, and you'll get to see stuff that we post daily, Monday to Friday, along with other stuff which team members do as well. We also have our YouTube channel. Please subscribe to us on YouTube at Harts Limited, and simply because you'll be able to be notified of any new stuff that's coming out. We have recorded about 8 videos and another podcast, and those are going to be released over the next few weeks and months on a variety of topics, so don't miss out on that, and you'll be able to catch up on those coming shortly. Again, we're on X, and we're also on Spotify, so you can listen to some of these podcasts on your way home, if that's what you fancy. Okay, next webinars and events. The next event we have is on the 19th of June next month. This is our usual business club lunch at Holling Hall. It's a great way to network with fellow professionals and potential clients and customers, whereby we normally have 50 to 60 people for lunch, and it's joint with the North Cheshire Chamber of Commerce and Orbit Developments. So please feel free to come along and join us on that. If you want to book on, then all you need to do is go to our events page on our website and you can book on from there. And just as a reminder, we had a number of our team that actually did Born Survivor. These are just 4 of the team that did it, and quite remarkably, they came away without any injuries, which I think some of them were half expecting. You can still donate. We've so far raised over £2,000 for East Cheshire Hospice, but you can still donate if you want to the cause, and the details are on the bottom of the page there. So please feel free to donate if you can, all for a fantastic cause. And we normally give you a quick update before we start the actual webinar. Bear in mind, we've got Companies House reform going through at the moment. So charges in relation to Companies House have increased. We have notified a lot of our clients, but if you want information about that, please feel free to get in touch and we'll be able to let you know what those are. National insurance, hopefully, if you are employed and you were paying some national insurance, you will see that that amount has actually started to reduce because we've had the latest cut, which was announced in the last budget. Benefits in kind season, we need to declare any benefits that you've had on forms P11D by July, but so if you've had any benefits, then you need to let us know and we'll be able to put those on various forms. And also self-assessment time, would you believe we are past the 5th of April. If you want your self-assessment return doing quickly, please get in touch and we'll be able to sort that out for you. And finally, you see there planning sessions. I work with a number of businesses in relation to helping them plan for what they actually want. It's a question of looking where they are now, where they want to be in, say, 5 years' time, and then how to get there. If you're interested in having some sort of planning session, then please feel free to get in touch. You will find it eye-opening, believe me. Okay, on to today's topic, which is My Mate Down the Pub Told Me About This and Other Myths. We get asked all sorts of questions and we get told all sorts of things over the years. And this is some of the ones that we've come across probably mainly over the last 12 months or so, would you believe? So we still get asked these questions on a regular basis. I'm going to start off this section with a section on cars, because we get our cars are one of the most common questions we are asked. And one of the ones that keeps cropping up is that everyone seems to think that their car is a pool car, so that no benefit in kind arises. But bear in mind that you're charged tax on benefits in kind, basically based on the list price of the car and its CO2 emissions. And if you're not driving an electric vehicle, these amounts can be substantial. So often it's not the case that it would be better off having your car in the business if it's a normal diesel or petrol car. So we often people say, oh, well, yeah, actually it's a pool car, I only use it for business. Well, is it really a pool car? You actually have to comply with 5 conditions, and these are the 5 conditions. It's actually available to and actually used by more than one employee. It's made available in the case of each of those employees by reason of their employment. Okay, you might do the next 2. You might have done those 2, but it's not ordinarily just used by one of them to the exclusion of the others. So you're the director, you take it home at night, no one else is insured in it. Well, that then fails as a pool car. Any private use by an employee is merely incidental to the business use of it. And the final one, which catches out a lot of people as well, it is not normally kept overnight on or near the residence of any employees unless it's kept on the premises occupied by the provider of the car. That doesn't mean that if you work from home, then you can keep your car at home. That fails on that test. So as you can see, you have to meet all 5 conditions before you actually can ensure that it's a pool car. If it fails any of the conditions, might be regarded as a shared car, but basically employers need to be able to demonstrate that the conditions for the car to be a pool vehicle have been met. So for instance, you've got to keep mileage records to show when the car was used, by whom, and for what journeys. Okay, so just going over that again, you've got to satisfy those 5 conditions. You can't just say, well, I work from home, I keep my car at home, it's only there because it's for business use and so on. That will fail. It will not be a pool car. Vans are treated differently. There's a different regime for vans than for cars. So if you keep your van at home, that home to work is actually allowable as a van. And you might want to consider double cab pickups if you want to, because they have a lower benefit in kind rate than cars. So there's all sorts of stuff that we can have a look at there. If you're not too sure about it, please get in touch and we can give you an example and the potential cost of what it is that you're looking at. So is your car a genuine pool car? What are the actual insurance requirements? Is your car insured for business use only? What's in your employment contract? Are you allowed to use it for business purposes or allowed to use it for private purposes? Where do you actually park it? And is there a disciplinary measure for not keeping it in line with the employment contracts? All of these factors are taken into account when actually you're looking at pool cars. Can I claim the VAT back when I purchase of my car because it's electric? The answer to that is a no. The electric cars have the same VAT regime as any other vehicle. And so therefore it means that no, you can't claim the VAT back on the purchase of a car just because it's electric, unless of course you might be a taxi driver or a driving instructor with dual controls or a similar sort of business. So very limited circumstances. Leased cars, if you lease your vehicle, then potentially you can claim 50% of the VAT of the leasing cost back. 50% of the VAT on the leasing can be reclaimed. It all depends on how that lease is set up, but in most cases that will apply. However, if you do buy an electric vehicle, there are other great tax benefits. So you might not be able to claim the VAT back, but for corporation tax, you might well be able to claim 100% of the cost of the vehicle back. And that's if it's a brand new electric vehicle. It doesn't apply to second-hand vehicles. It only applies to brand new electric vehicles. The benefit in kind on those vehicles is very low. So at the moment, 2%, but rising to 3%, 4%, and 5% over the next few years. So for argument's sake, you take a new electric vehicle for £40,000 and the benefit in kind rate is 2%. 2% of £40,000 is £800. You're taxed on £800. Even for a higher rate taxpayer, that's only £320 a year for the company to own your vehicle, meet the cost of the vehicle, meet the cost of the insurance, any repairs, and so on. So it is, at the moment, a great tax benefit. We also get asked, I only use my car for business. Well, do you really? The relevant term for the revenue is it has to be made available for private use. So therefore, what happens in an emergency? You get called out somewhere for a family emergency in the middle of the night, you jump in the car and off you go. Well, therefore, that car is made available for private use, and therefore it is not used for business use only, and therefore will attract a benefit in kind. What does your insurance say? Are you insured only for business use, or are you social, domestic and pleasure and business use as well, which tends to be what a lot of people are? That will mean that your car is used for private purposes. So it only has to be made available for private use for you to fail the test. It's not a question of whether you actually use it for business or not. It's that made availability. I can claim all my car expenses as well as my business mileage. Well, not really, you can't. If you've got a company car and the company pays for everything, then you can't claim mileage as well. So in this case, if your company pays for your vehicle, pays for insurance, pays for your petrol, and so on, you then can't claim for business miles as well. Where you can claim is if it only have a company car and it don't provide fuel, in which case you can claim the fuel cost, and that varies quarter on quarter, and we can get the actual rates for the size of vehicle that you actually have. So that is something that you can claim if you're not being paid the mileage rate. Sorry, the benefit in the fuel rate. If you don't have a company car, then you can claim mileage rate at the rate of 45p a mile for the first 10,000 miles and 25p a mile thereafter. Now, these rates have been set for donkey's years and they haven't changed. Doesn't look like they're going to get changed, so you have to stick on that for the moment. But you have to keep a record of the business miles that you actually do to be able to claim the 45p a mile and 25p a mile after the 10,000, and that's in any tax year. Anybody got any questions? Anyone want to raise anything? Please feel free to do so. Stick it in the chat box, unmute yourself or whatever. Moving on from cars, VAT. We came across this one not that long ago. I can have one company for my VAT registered clients and one for my non-VAT registered clients. Actually, you can't. That's illegal. Artificially splitting your business can't be done. So, for instance, we had a cleaning company that wanted to do one company for its commercial clients and one for its domestic clients because the domestic clients were not VAT registered. Well, you're artificially splitting your business. You have a cleaning company. That is it. So if there are very specific reasons for splitting up a business, then it can be considered. But generally, splitting business to avoid VAT registration is not allowed. It's basically to stop people having, and I've come across this many, many moons ago, where one company ran the business on a Monday, one ran it on a Tuesday, one ran it on a Wednesday, and so on to escape the VAT threshold. That you cannot do. Expense claims. Let's have a look. We've got quite a few on these now. I need a suit for work, so I can claim this through the business. Unfortunately not. As accountants, I'd love to be able to claim all the suits that I've bought over the years, but you can't. You have what's called duality of purpose rules, which basically where it falls down on. You would wear that suit for non-work reasons as well as for work reasons, and therefore it will fail. Protective clothing, though, is okay, or embroidered named workwear can be okay as well. So what is protective clothing? Well, if you're just buying jeans because that's what you normally wear for work and you get dirty and so on, that's not protective clothing. Wearing knee pads for jeans would be. Wearing steel toe cap boots in the construction industry would be. Wearing high-vis vests would be. Those are all protective clothing and can be claimed for. But general work shirts, work trousers, jeans, whatever it is, you buy a pair of jeans because they get very dirty and they get very mucky, but you only wear them for work, unfortunately, doesn't count. Dinner's on me. I can put it all through the business. Well, yeah, you can. If it's genuinely entertaining, then you can. However, you can't claim any VAT back because you're not allowed to claim any VAT back on any entertaining, and you can't have a corporation tax or an income tax deduction for it either. However, you're saying, well, actually, I'm going out on a Saturday night with my mates. Then no, you can't. You can't put that through the business. That is not a business expense. You're not entertaining under business for business purposes. You're just going out with your friends. So again, just watch that because HMRC are well aware of what goes on. I can put my Man United tickets through the business and call it entertaining. There's probably an argument there to say, well, is Man United entertaining at the moment? But that's another matter altogether. On the Spurs. Anyway, are you actually using it for entertaining? Are you using the tickets for yourself and you take somebody else along? Remember, all entertaining is disallowed for tax. If you genuinely give away the tickets to each game, then yes, that's entertaining. Do you regularly go with somebody, then potentially it's entertaining, but potentially you're also opening yourself up to a benefit in kind charge on those tickets because it's you that's going all the time and you just happen to take somebody else. So you just have to be very careful. Came across this with an inquiry case a few years ago. So remember though, all entertaining is disallowed for tax. I'm going to business conference in Orlando, so I can put all the costs through the business. Yeah, not necessarily, basically, and very much depends on the circumstances of the case. If you are going for a short business conference and it may be over, say, 4 days, then it's a short trip, you're going specifically for that, then potentially that will be fine. If you're going on a short business trip for 4 days and you're taking your wife and your children and you decide to go and visit Disney World and enjoy yourself whilst you're there, then it will fail on the duality of purpose rules. So how long is the conference? How long is the trip? It all very much depends on the circumstances of the case. And also you've got to consider remoteness as well. So if you're a local contractor here in Macclesfield and all your work is done within the Northwest area, why are you going over to a conference in America, which you think might be able to help you? Is it really for your business or is it just a bit of a jolly? So you just need to be aware of that. And make sure that you've got a genuine reason for going to that business trip and it is only a business trip. That way you will be able to put the costs through the business, but you just need to be careful and it very much depends on the circumstances of each case. I can put all my house running costs through the business if I work from home. Yeah, I wouldn't really recommend doing this. What you can put through very much depends on how you're set up, as there are different rules for a limited company and a sole trader partnership. So let's consider first of all sole trader and a partnership. If you're a sole trader, what you can do is say, for instance, I might have 8 rooms in my house. I use 1 room for business purposes, but I don't use it exclusively for business purposes. That's another point you just need to be aware of, and I'll come on to why. In that case, you can say, well, actually, what is my council tax? What are my mortgage interest payments? What's my gas? What's my electric? You can then take 1/8 of that, and then you can potentially say, well, actually, I only use that room 50% of the time. So you then take 50% of that cost. That may be a method of calculating what sort of costs you can put through as a sole trader or as a partner in the business. You can't put through absolutely everything. And the reason we say you can't have it exclusively for business use is that if you then come to sell your home, you potentially might fail on part of the principal private residence rules, and that's the last thing that you want to be doing. So never ensure that it's only for business use, exclusively for business use for that one room. Where you're a limited company, it's probably much simpler to typically take the £6 a week allowance, which is there for working from home. And if you are required to work from home as part of your contract, then you can put that through at the £6 a week. Rules change whilst we're in COVID. Anybody working from home could just claim the £6 a week. Now you have to be required to work from home. Any questions so far? Right. This one confuses a lot of people. As a sole trader, I'm taxed on what I take from the business. No, you're not. You're taxed on the profits of the business before any amounts you take out for yourself. So if you have turnover of £50,000 and profits of £20,000, you are taxed on £20,000. If you have taken £30,000 out of the business because there's cash coming from somewhere else or whatever, you are not taxed on that. You're taxed purely on the profit of the business before what you have drawn. So for instance, as an example, again, a new business starts up with nothing, turns over £70,000, makes a profit of £50,000, but says, I don't want to take any of the money out. I need it within the business. Only draws out £20,000. He will not be taxed on the 20,000. He will be taxed on the profit. So it works both ways. You are taxed on whatever the profit is rather than what you actually draw out of the business. Same applies to partnership and LLPs. Limited companies, obviously completely different, and that's a separate issue. But we often get asked this question, and sometimes people find it quite difficult to understand that a sole trader is taxed on the profit of the business before whatever you draw out for yourself. I'm treated as self-employed as I have my own limited company. Well, you've got a conflict there in the title, basically. If you have your own personal service company, you are a director of your own limited company. You are employed by that company and treated for tax purposes the same as every other employee. So you then have to prepare limited company accounts. You have a pay-as-you-earn scheme. You draw out a salary, typically salary and dividends. You are not self-employed for tax purposes. You are treated as an employee with your own limited company. We often get that because people ask for a mortgage reference and they say to their mortgage provider, well, actually, yeah, I'm self-employed. And we often get the mortgage certificate to complete, to come through to complete, and it comes through as the wrong type because we know they're actually a limited company. So if you have your own personal service company, you are a limited company. You are not self-employed for tax purposes. HMRC are always right. Yeah, not always right. They are sometimes right, but whatever the impression HMRC might seem to give, they are not always right. So if you get stuff you think, well, that must be okay, you get a correspondence from them and say, well, actually, yeah, that looks right, or I'm not sure, but it must be right because it's come from the revenue. Don't believe it. Always get it checked out. Always send stuff through to us if you're clients of ours, and we will be able to sort that out for you. Now, these are just some of the problems we deal with on a daily basis. Allocations of tax payments go to the wrong year. That happens on a very regular basis. And we have clients phoning up saying, why have I got this demand for tax? And they've added interest on and so on. We look at it and they've posted the payment for that year to the wrong year. And so we see on the revenues website that they have an overpayment sitting on 1 year and an underpayment sitting on another year. Yet the two never seem to net off. It happens quite regularly. We have duplication of records, where there might be two records for the same person, and they're claiming and demanding stuff on one record. For instance, there might be a late filing penalty for a self-assessment return, and yet they've submitted it under a different reference because the revenue duplicated it. They're often chasing payment when none is due. Again, it can apply to the first two, duplication of records, and also allocation of tax payments to the wrong year. Incorrect tax codes, these happen more than regularly. They may well send you out a new tax code, forgot that you've left a previous employment, and apply the wrong tax code. Now, if you are not submitting a self-assessment return, then you are going to be paying the wrong amount of tax. Your self-assessment return will tidy it all up, and it will all wash through when that is completed. We also experience extremely long waiting times to speak to somebody. Some of the agents' advice lines have been closed, where we used to have direct access to HMRC, much quicker response times. Those have tend to have disappeared. So if you ask us to speak to the revenue, we'll also be hanging on for about half an hour or so at least before we actually get through to somebody. And we also experience the same problems as everybody else, as being cut off before you get the chance to speak to somebody. Incorrect penalty notices are issued. Often the revenue will issue, come February, March, April time, penalties for late filing of self-assessment returns when the returns have actually been filed. It's just because they're not being processed on their system for whatever reason. That happens regularly. So if you get a penalty notice and you think you shouldn't have had one, then please get in touch and we can sort that out for you. Promised replies to correspondence which never arrive. We have got an ongoing issue where they've promised us a reply to a letter that we said, and they said, yeah, we'll reply to it in the next few weeks. Oh, then it comes to the next few weeks, it's still not happened, and so on and so forth. The service is not great at the revenue, and they even get the tax rules wrong as well. So a lot of problems we deal with on a daily basis. Wayne, have you got any more anything more you'd like to add on those sort of problems? I've got my tax manager here sitting with me.
No, it's really very much as you say. It's frustrating as much as anything. Yes, they may well be underfunded and everything, but
okay,
it's just a difficult time.
It is a difficult time. It is frustrating, and there's not a lot we can do about it. So we suffer with the rest of you. However, don't be under any illusions about HMRC will never actually catch me. They have a very sophisticated system now called Connect, and this pulls information from a variety of sources. This Connect system, called the Snooper computer, helps HMRC to gather information from banks, peer-to-peer lenders and platforms like social media accounts, and they will build up a picture of what you're spending your money on. So if they then think that your lifestyle doesn't match what you're actually putting down on your returns, that can trigger an inquiry. They also look at land registry records and see whether you're able to afford buying such a property. So again, if you're going out and buying such a property and it looks like you haven't got the wherewithal to be able to do so, that also can trigger an inquiry as well. So they are becoming very sophisticated, and that is just the tip of the iceberg. This is some of the records that HMRC can access. Obviously your tax returns, but including your VAT, pay-as-you-earn income tax and corporation tax. They can access your bank account details and pensions. They look at your online social networking, such as Facebook and Instagram. They look at credit reference agencies. They will have a look at Amazon, eBay, Gumtree, and similar sales websites as well to see if you're selling stuff on there on a regular basis and not declaring it on your tax return. They will look at your credit and debit card accounts. They'll look at online providers such as PayPal. They can get travel information, including flights and insurance. They can look at Companies House, Land Registry, Border Agency. They have foreign tax jurisdictions, including treaties and automatic exchange agreements with various countries. They will look at property websites and have information as Zoopla and Rightmove. They'll look at Google Street View, would you believe, as well. Council tax records, DVI records, DWP records, electoral roll. Angela Rayner springs to mind. Insurance companies and charities commission. So this is where they can get a lot of their information from. So don't be fooled that we're living back in the dark ages. Please remember it is 2024, not 1974 or even 2004. They have access to a wide variety of information. So if you want to sleep at night, make sure that you declare everything on your return, because HMRC can catch up with you. They also receive automatically information from overseas tax authorities as well. There are a number of campaigns out there. If you wanted to come clean, if you've forgotten to declare something, or you've realised you've had some income, you've not declared it, please get in touch so we can give you the right advice. It's far better you going to the revenue first rather than them coming to you first and then having to look at various stuff and information. I expect my tax refund will be paid in the next few days. Yeah, sometimes it will be, but don't plan on it. HMRC are hanging on to cash for as long as they can. And we are experiencing long delays, in many cases several months worth, for clients to receive their tax refund. And often when we phone up to say, well, when can we expect to get our tax refund? It'll say, yeah, we're processing it. And if it's now, we're in May, we'll maybe say, yeah, you'll have it sent to you in August. Why it takes so long to do that, I don't know, because it's only at the press of a button that they can actually do it. But that's how they're doing it. They are hanging on to the money for as long as possible. So if you think you're going to get it back quickly, just be careful. If you needed the money urgently, just be careful, because it might not happen that quickly. Any questions so far? I think we've got one comment in the chat box. Yeah, I agree with you, Carol. There's a lot of information they can actually get to. I expect HMRC to deal with my letter quickly, as it's urgent. Don't bank on it. We're seeing some extremely long delays in receiving replies to letters overall, and so much so we've actually started to keep a record of them. So this is for our record, just from April this year, so just from last month. We had a penalty notice issued for 22-23 tax year to a deceased client, where HMRC were told in October 23 that no return was required. We called to speak to the agent advice line and advised that although HMRC received the letter in early October, this is the bereavement team, we have a special bereavement team, we're still dealing with postal backlogs going back to August 2023, which quite frankly is outrageous when you're dealing with a bereaved person. It is staggering, but those are the sort of backlogs that we're looking at. And another one, an 8-week time minimum for processing of paper 64-8 forms. 64-8 forms are the forms which give us authority to act on your behalf. So even though they've been received and they can see it on the communication log, they can't provide us with any information until the forms have been processed. So that basically means that we've got to wait 2 months from taking on a client before we can actually access any information at HMRC relating to that particular client. So those are just a couple of details in relation to dealing with correspondence. It is taking quite a long time to get replies to certain letters. Moving on, tax avoidance, tax evasion. So what's the difference? People often get it mixed up. Avoidance is legal and evasion isn't. Whether you like avoidance or not is another matter. Evasion is totally illegal. But how far can you go down the avoidance route? It's very subjective. Avoidance can be taken, is generally taken to mean more aggressive tax planning, which goes contrary to the spirit of the tax rules. Not breaking any rules, but it can go against the spirit of it. So in theory, you putting money into an ISA avoids tax because an ISA is a tax-free wrapper. But it would never be considered as being tax avoidance. But in theory, yes, it is a tax avoidance at one level. So what you've got to be careful of is looking and seeing what might be considered tax avoidance. And it's very difficult sometimes to make that distinction. So if you're in that position, please get some advice or get in touch and we would be happy to help. Property section. I don't have to declare my income as I make a loss from renting out my property. Maybe you may well have made a loss from renting it out, but you might want to declare that income anyway. How have you calculated your loss? What have you brought into the loss-making calculation? What is capital and what is revenue? Capital will not be against your income. Revenue costs will be against your income. If you declare your loss, you can carry those losses forward to be offset against any future profit that that property may make. So again, it's worthwhile making sure that you have your property income or even losses declared on the return. We also have a property allowance, which basically means that the first £1,000 worth of costs we can deduct from any income you might have. It's £1,000 a year. So if anyone's got any property that's rented out to a third party, unconnected third party, then you can claim the £1,000 allowance. Now, recently, we've seen a spate of nudge letters coming out. These are letters from HMRC, which they look at trying to get you to either correct your tax affairs or review your own tax affairs. And they've issued one recently in relation to mortgage interest on property. And how have you calculated the mortgage interest that you've deducted from your property income? Because the rules changed quite a few years ago now, and you can only have basic rate relief on that. So they're using this as an opportunity to then say, well, actually, let's check with all the property people that we've got and see if any of them have actually calculated this mortgage interest deduction correctly. So always worthwhile putting the loss down on the return. The other thing that might happen is what happens when you come to sell that property. Suddenly you're declaring that you've got a sale of a property which you've never declared previously, yet you've been renting it out. In a way, it can be red rag to a bull to HMRC. They may well open an inquiry as a result. So well worth making sure that you actually put down property and check that you're calculating that loss correctly. There is the Let Property campaign, which is still available to people if you want to come clean on your rental income. There is a facility to be able to do that at reduced penalty rates. Gifting my house. I can gift my house without any tax implications. I can give my car. I can give my home away. That would mean I don't have to pay any care home costs. Wow. Not exactly. You can fall foul of a whole range of taxes if you're not extremely careful about this. Local authorities will do everything they can to try and get you to pay the care home fees. They will go back quite a long time to see what you've done with the property, to see whether it's been done at a time when you were considering care home costs or there was a problem with one of the residents in the home and so on. So again, general advice here in gifting your house is don't go there without very, very specific advice. It is something which you can lead to a whole host of problems. And if you've given the house away, did you have a power of attorney? Did you have capacity to be able to do such a thing? Because often they're done at the time where the person gifting it doesn't have the capacity to be able to do it. That will negate the gift for the tax purposes, and certainly for care home costs, they will have a look at that. So get specific advice in relation to this. I don't pay any tax on the interest I receive. Yeah, possibly. That depends. Savings allowance is £1,000 for a basic rate taxpayer, £500 for a higher rate taxpayer. So let's look at this. Recently, we've had quite high interest rates on savings. You can certainly get 5% return on an instant access or a fixed rate savings account. So therefore, you only need £10,000 of savings to trigger a tax liability. If you're a 40% taxpayer, the first £500 will be tax-free. So do I need to pay some tax? Well, potentially, yes. So be careful, as HMRC already know the amount of interest that you receive. And I think this is going to particularly affect people for the 23-24 tax year, which has just finished. Many people may well have a tax liability on savings income for the first time for that year because of the high interest rates. So just watch that. If you have received a lot of interest, because the banks pay the interest gross, you won't have had tax deducted in majority of cases. So have a look and see how much interest you've received. If you have received more than £500 for a higher rate taxpayer, or £1,000 for a basic rate taxpayer, then you need to complete a self-assessment return form and declare that interest on that return. It's one of the downsides of high interest rates. Another of the downsides, I suppose, of high interest rates, and that you've got to complete a self-assessment return if you've got some savings. I have to pay tax on some casual earnings I receive. There was a lot of hoo-ha over this in the press not so long ago. Every person is entitled to a trading allowance of £1,000 per annum. So if you do some casual work for less than this, on top of your pay as you earn salary, then you don't need to bother. If you earn more than this, you can then deduct the £1,000 allowance if you don't have any costs in excess of £1,000. So bear in mind this can apply to selling off stuff on eBay, Etsy, renting out your drive, or getting other small amounts that you receive. This is one way where HMRC is saying, well, we're not too interested. You can earn £1,000 and doing various bits and bobs, and you don't have to complete a tax return. It stops lots of people getting tax returns. So, for instance, it might be, I don't know, a referee on a Sunday league gets paid for refereeing a game. He doesn't have to declare that income as long as it's below the £1,000 limit. So bear in mind that you do get £1,000 limit. There was an argument, there was something in the press not so long ago about the revenue having a go and saying, well, actually, yes, you need to declare all this income, but you've got £1,000. Nothing has changed on that. It's been like that for quite a few years. I'm not personally liable for my bounce back loan. If you remember at the beginning of COVID, which seems an age away, but it was only about 4 years ago, we had people who started to get bounce back loans and they could claim maximum up to £50,000, and people thought, yeah, great, it was just free money. Well, the answer to this question is it depends. The banks might not come back to you. You might not have given a personal guarantee, but then you've got to look at what have you used the loan for, and can you repay the loan? We're seeing an increasing number of businesses now unable to repay the bounce back loan, and then the liquidator gets involved. Well, at the moment, a liquidator has a duty to review any business that has received a bounce back loan and has gone into liquidation, and it will review how that money was used. If it wasn't used for business purposes, or people used it just to go out and put an extension on the house or go on holiday or whatever it was, then the liquidator has a duty to recover that money. So although you're not personally liable from the banks, the liquidators will make you personally liable for repaying that money. So you do need to be extremely careful. As long as you repay it, tends to be okay. But just watch it if you are struggling and you do have an outstanding bounce back loan. I can give the shares in my company to my children to reduce my tax bill. You can do, but they've got to be over 18. If your children are under 18, then any income they received as a result of the shares that they've got will be taxed on you as a parent. If you're over 18, do you really want to give income producing shares to your children? Do you really want to have your 18-year-old son or daughter having a share in the business that you've built up? Maybe. If you want to bring them into the business, but there may well be other implications. What type of shares are they as well? Property investment or trading company is different. And are there restrictions on the shares? So take advice before you decide to give away shares in your company. Normally we say, normally I say to clients that this is probably one of the last things you want to do is you're building up your company and you start giving away shares unless you want to bring your children into the business. And finally, just one for ourselves. Filling in my self-assessment form is simple. There are only 3 entries on it, so why does it cost so much? Well, we've pinched this illustration off the internet, so thank you whoever put it up there, but it's a great example of what we do. So the top bit is what our clients see. So we gather information, you think we should send you a covering letter, we put the figures on the return, we tell you how much to pay. However, all the stuff that's underneath there is what you don't see, the sort of work that we do. So we identify any errors or omissions in the information you've given us. We look at any reliefs that can be claimed. We look at the notes and records from one year to the next. We check and correct your pay-as-you-earn tax code. We remove items not relevant to return. We check the process of return and the payment of the refund. We maintain a full supporting file for future reference, consider aspects which may require, etc., etc. So as you can see, it's not just as simple as putting 3 figures onto your self-assessment return. There is a fair amount which work that goes into it. And we have to charge you for that based on, and we want to give you the best service that we can, hence the fee for completing a self-assessment return. Whilst there may only be 2 or 3 entries on it, we still have to do a fair amount of work in to be able to do so. That brings me to the final slide, which is questions and answers. Has anybody got any questions or anything they want to raise before we finish? And if anyone wants to raise any questions once the recording is finished, then please stay on the line and we'll be able to do so. I'm around for quite a few minutes left yet, so please feel free to hang on. I haven't got any questions in the chat box, and if you want to unmute yourself and ask any questions, then please feel free to do so. At the moment, no one's not got any questions from anybody. Well, thank you very much indeed for joining us. Hope you can join us for our business lunch at Holland Hall next month. Details are on our website, and I'll look forward to seeing you on the next webinar. Thank you very much indeed.